Hey everyone, welcome to The Explainer. Today we're looking at a massive, highly debated structural shift that's happening right now in the 2026 tech investing landscape. Across financial communities everywhere, this fiery debate has basically just exploded. You see, for years, one index has undeniably ruled the tech world, but we are currently witnessing a completely seismic migration of capital. Investors are literally rethinking their entire portfolios from the ground up. And the crazy part, they aren't doing it based on emotion or rumors, they're doing it based on hard mathematical data. So let's look at the exact mechanics of what's happening because the data we found is absolutely fascinating.
Okay, let's dive right into this. Why on earth are investors suddenly abandoning the absolute champion of the last decade? I mean, for years, the FANG Index has possessed this almost cult-like following. It's been the undisputed king of returns, capturing those massive tech bull runs just beautifully. Yet suddenly we're seeing this dramatic pivot away from it, with money flowing directly into the arms of the broader NASDAQ 100 index. If FANG Plus has been the proven winner, this sudden jump ship behavior seems like a total mystery, right? But as you'll see, the market has realized something really profound about the changing architecture of 2026.
And look, to show you this isn't just some internet rumor, let's look at the hard data. Fund inflow rates, which is essentially the momentum of new money pouring in, saw a really sudden and aggressive spike around April of 2026. FANG Plus is sitting at an inflow rate of 12.85%, which, is still solid, but the NASDAQ 100 has aggressively overtaken it, surging up to 14.16%. So while FANG Plus might still hold a massive amount of total net assets, the momentum, the popularity, and most importantly, the new money have completely shifted. This tells us that investors are anticipating a very, very different future.
All right, moving into Section 1, Structural Identities, Special Forces versus the Army.
Our source material uses a truly brilliant analogy to explain this, and I love it. Think of FANG Plus as a 10-company elite special forces unit. It's hyper-concentrated, it's highly aggressive, taking all of its capital and focusing it on a pure tech, high-risk, high-reward mission. Recently, it's essentially evolved into a pure AI infrastructure fund with giants like NVIDIA and Broadcom. On the other side, the NASDAQ 100 is your 100-company balanced army. Yes, for sure it's tech-heavy, but it brings along defensive units too, consumer goods companies like Costco, effectively bringing bulk hot dogs and healthcare to the front lines. The design philosophies just couldn't be more different. One is designed to strike hard in a bull market, the other is designed to win a long, grinding war.
Now we have to impartially acknowledge history here. If you look at the medium to long term over the last 5 to 10 years, FANG Plus has absolutely been the undisputed king. Looking at this staggering number, a 284% return for FANG Plus over a recent 5-year stretch, compared to 222% for the NASDAQ 100. I mean, compared to standard global or S&P indices, this is in a completely different stratosphere of wealth creation. And this astonishing track record is exactly why investors have held on to it so tightly. It perfectly captured the era of hypergrowth.
Which brings us to Section 2, Mechanics and Hidden Costs. This brings us to a major structural vulnerability in FANG Plus. It uses a system called equal weight rebalancing. Every single quarter, the fund mechanically adjusts so that all 10 companies make up exactly 10% of the portfolio. Imagine NVIDIA or Micron has an incredible run. Their stock skyrockets and they become 15% of the portfolio. What does FANG Plus do? The system mechanically forces the fund to sell off 5% of those massive winners and use that cash to buy the struggling companies that dropped to 7%. In investing, the golden rule is let your winners run and cut your losers. But FANG Plus actually operates as an anti-momentum engine, constantly trimming its absolute best performers.
Contrast this with how the NASDAQ 100 works. It uses market cap weighting. Now this is a fully pro-momentum structure. If a company does brilliantly and its market capitalization just explodes, the NASDAQ 100 simply lets it grow. It naturally allows that winning company to take up a larger and larger percentage of the index. It doesn't punish success by trimming those profits. It captures the fruit of that growth entirely, which makes it incredibly rational for a long-term hold in a trend-heavy market.
So the crucial point is you really can't talk about long-term investing without addressing the silent killer of wealth, hidden costs. FANG Plus carries a management fee of around 0.77%. Meanwhile, new, highly competitive NASDAQ 100 funds are hitting the market with fees as low as roughly 0.19%. Guys, that is a massive 4x difference. And when you factor in hidden trading costs, it can sometimes be closer to a 5x difference. Over 10 or 20 years of compounding interest, this seemingly tiny percentage difference literally translates to hundreds of thousands of dollars missing from your final portfolio.
All right, let's look at Section 3, the mega IPO supercycle.
Our sources point out that right now, the data shows the market is bracing for a historic rush of initial public offerings. We are talking about generational, multi-trillion-dollar AI and space infrastructure giants like SpaceX, OpenAI, and Anthropic gearing up to go public. For instance, SpaceX isn't just a rocket company anymore. It's evolved into a massive AI infrastructure entity. The combined capital raised by these upcoming IPOs is expected to surpass all U.S. tech IPOs from the last several years combined. This is a massive shift, and frankly, everyone wants a piece of this action.
And this brilliantly illustrates the ultimate advantage of the NASDAQ 100 in 2026. The NASDAQ has recently implemented a new fast entry rule. For mega IPOs like SpaceX, the index will mechanically scoop up shares just 15 days after the IPO. If you hold the NASDAQ 100, you automatically capture that massive early buying pressure. FANG Plus, on the other hand, is handcuffed. It has a strict 60-day minimum wait time. Even worse, because it's locked to exactly 10 companies, to let a giant like SpaceX in, it would agonizingly have to kick out an existing powerhouse, like an NVIDIA or a Broadcom. FANG Plus investors might be stuck watching from the sidelines during the absolute most explosive growth phase.
Moving to Section 4, Macro Headwinds and Defenses.
Because, when the market turns red, hyper-concentration becomes your worst enemy. Look at the numbers from the Q1 slump earlier this year. The broader NASDAQ 100 dropped by 6%. Painful? Yes. But FANG Plus, it suffered double the damage, dropping roughly 12%. Because FANG Plus is basically a pure high-risk tech bet. When the tech sector gets hit, there is absolutely no safety net. The volatility is breathtaking. And for a lot of investors, that level of downside is incredibly stressful to hold through.
So why did that drop happen? Well, the 2026 macroeconomic reality features sticky inflation and central banks keeping interest rates stubbornly high, hovering around that 5% mark. In the financial world, this creates what's called high duration risk for pure tech companies whose valuations rely really heavily on future earnings. When rates are high, the present value of those future earnings just plummets. But this is exactly where the NASDAQ 100 shines. Because it includes those defensive consumer and healthcare stocks we mentioned earlier, it has this built-in cushion that softens the blow when high tech takes a hit.
Section 5, the long-term horizon. Now, what's really interesting about this slide is that when you step back, a global perspective reveals something fascinating. Investing in top U.S. tech companies isn't just betting on the American economy anymore. Looking at the data, the top tech giants actually draw an average of 52% of their revenue from overseas markets, compared to 48% domestically. So betting on the NASDAQ 100 is effectively betting on the long-term expansion of the global middle class, global internet adoption, and total global GDP. It's a highly diversified bet on human progress across the entire planet.
So, with all of these structural advantages stacking up in favor of the NASDAQ 100, you might be looking at your own portfolio and feeling a sense of panic. You might literally be asking yourself right now, should I sell all my FANG Plus holdings immediately?
Well, our sources are very clear on this. Mathematically, panic selling is almost always a mistake. If you have profits in FANG Plus and you just sell them off, you'll likely trigger a capital gains tax hit of roughly 20%. This creates a tax drag that instantly halts the incredible power of your compound interest. So what's the optimal middle ground here? The data suggests holding your existing FANG Plus assets to avoid those tax penalties, but directing all of your new investment capital moving forward into the NASDAQ 100. This way, you keep your past momentum, but you seamlessly align your future money with the better structural mechanics.
Because at the end of the day, investing is fundamentally a mental game. There's no single perfect answer, only the answer that fits your specific risk tolerance and your understanding of the market mechanics. You now have the data on rebalancing flaws, the hidden fees, and that massive upcoming mega IPO supercycle. So I leave you with this final thought to ponder as you look at your own portfolio. Which index lets you sleep soundly at night, knowing you are perfectly positioned to capture the future of global innovation?